Good morning from our global headquarters in New York. I'm Danny Berger. Manus Cranny is off this week. You're welcome to Bloomberg Brief. Let's set your agenda. Not worried after 4 straight weeks of equity declines. Treasury Secretary Scott Bessent says corrections are healthy and normal. Pushing for an end to the war, President Trump says that he'll speak with President Putin tomorrow, saying progress is being made. Pumping up consumption, China maps out its plans to boost spending. Happy Monday to you. I hope you are ready for another busy week. We have central banks abound, Fed, BOJ, BOE, retail sales data today, housing data today. We had a rally on Friday, and some of the steam is taken out of that this morning. S&P 500 futures down 0.5%. Same with NASDAQ 100 futures. By the way, if we post another decline this week, it'll be 5 consecutive weeks of declines. That is the longest losing streak since 2022. Strategists are revisiting their target. RBC's Lori Calvasina downgrading her year-end target to 6,200 from 6,500 on a dimmer economic outlook. Your Treasury market this morning, more stability after a jump in yields on Friday. That UMich figure really upsetting the bond market. Inflation expectations higher, the highest since November 2022. Unease about the economy. Your 2-year yields at 4%, your 10-year yield at 4.2. Oil advancing this morning at nearly 0.9%. China's planning to boost its economy. The risks in the Red Sea are growing, but I should say amid all of that, Goldman Sachs has cut its oil price target on economic weakness and OPEC Plus boosting output. Okay, a couple individual stocks we are keeping our eye on this morning. NVIDIA is gaining in the pre-market. They have a much anticipated AI conference coming up that will be closely watched by investors. Quantum computing stock IonQ also on the rise. It was among one of the top mid-cap stock gainers this week, so that continues up 5% in the pre-market. Tesla, however, is down in the pre-market, 1.7%. It leads tech and Mag 7 stocks lower this morning. We'll see again if that NVIDIA news conference can change any mind. We also had some news that Elon Musk is confirming that Starship, a SpaceX rocket, will be going to Mars by the end of 2026, carrying a Tesla Optimus robot. We'll see whether that actually happens. Now, setting you up for the show today, we're going to be speaking with Marija Veitmane of State Street. Later in the hour, we'll be catching up with Kathy Jones of Charles Schwab. 2 conversations you do not want to miss. Now, it's been a brutal month for markets, but U.S. Treasury Secretary Scott Bessent says that a correction is healthy and normal.
I'm not worried about the markets. Over the long term, if we put good tax policy in place, deregulation, and energy security, the markets will do great.
Joining us now is Marija Veitmane, Senior Multi-Asset Strategist at State Street. Marija, great to see you. So is this a healthy and normal correction?
Yes, good morning. Actually, I mean, it's not very often for me to agree with kind of U.S. administration, but yeah, no, I think it's healthy and normal correction. And the reason we're saying that is that the key point for us is that underlying earnings outlook has not been downgraded. So earnings, which is really the hard data that we all want to see, is still there, expected to continue. Yes, valuation's a bit lower. We've seen a very substantial position adjustment. And what is really exciting is that we're beginning to see institutional investors coming back. So we see buying of tech again. We're seeing some like unwind of European trade. So to us, yes, it was a correction. Now investors coming back.
This is the confusing thing, is that you see money moving in a way that sentiment isn't necessarily moving. You had, for example, AAII survey of individual investors. Those sentiment figures crashing. But Marija, as you point out, buying has happened. Bank of America pointed this out too. Last week was a record week for 2025 of buying of U.S. assets. What do you make of that disconnect between where some of the sentiment measures are and where some of the money flow is going?
Yeah, I think there are 2 things. One is like media focus on kind of slowdown, recession, trade is huge.
So it's our fault, Marija.
But what is really interesting, investors paying less and less attention to it. So we like measure narrative for like trade, for example, and it was the driver of equity market only like a couple months ago. Not anymore. Like R square of this narrative regression on stock market gone close to 0. Now we're worried about earnings, we're worried about sentiment, consumer spending. So I would say the retail number today would be super, super important. So that's probably number one. And secondly, soft versus hard data. Again, there is lots of kind of worries and concerns like labor market and future inflation. So that's where concerns are. Actually, hard data is not as weak. And I think that's a really important question. And that's why I'm immediately zeroing on earnings. And earnings, we haven't seen, and I mean, maybe it's too early because tariffs haven't been implemented, but we really are kind of unlikely to see big, sharp declines in earnings very quickly.
So let's then talk about what the catalyst is for the correction, the healthy correction to be over. What stops some of the bleed? We heard from Scott Bessent, again, the sound we just played, saying that over the long term, if we put good tax policy in place, deregulation, and energy security, the markets will do great. Is this a market that is waiting for that good news coming from the White House, from good news coming from Powell, from economic good news, Marija? What is the catalyst that gets this away from that healthy correction and allows us to resume a rally?
I mean, we are worried about recession, right? That's kind of an obvious worry given the kind of sentiment data we've seen. I think like today, if we get a strong retail number, I think that would alleviate a lot of those concerns. I think that kind of in the short term, but in the kind of medium term, what we had this idea of U.S. exceptionalism and fantastic growth, and investors really positioned for it. If we look at investor holdings at the start of the year, really elevated positions. A lot of it came out in like last couple of months, and as I said, now investors begin to come back. And you kind of quoting the numbers from Bank of America, very similar idea. So investors beginning to come back, but to restore confidence, I guess we need to see a little bit of retail sales coming stronger. I mean, we're only like a month away from corporate earnings, so that can potentially support as well.
If we look at European equity markets, Marija, there's one sector that stands out. Financials. Commerce Bank up 51% year to date. Unicredit 36%. Deutsche Bank 32%. You're getting worried about European financials. Why, Marija?
Well, if you want like a shocking headline, is that institutional investor holdings of European banks, or of benchmark position in European banks, is bigger than that of the U.S. tech sector. So in reality, the most crowded, the highest concentration risk is European financials, not U.S. tech anymore. And yes, European banks are having really strong underlying fundamentals. We see kind of they're very profitable, they're stable. We see yield curve being steeper, and kind of future profitability can continue to be strong. But investors really positioned for it. And valuation somewhat reflects that as well. So the current valuation in European banks is back to pre-GFC level. So we have a lot of good news priced in. It's hugely concentrated sector. We need to see delivery, and that's oftentimes a difficult situation in Europe.
So just to go back to where we started and incorporating this, Marija, this whole rotation from U.S. to Europe, again, not just a U.S. correction over, but is that simple trade, has that played out? Is that done? And if so, is there an unwind to be had? What does that look like?
I mean, as I said, we're beginning to see, we had about close to a couple of weeks of this kind of unwind of the unwind. So people are coming back to U.S. tech and selling European banks. So that's what we saw in the last couple of weeks. I mean, it's not really kind of reflected in a big way in prices yet. But to us, that kind of the thing we are watching really carefully, because investors have like adjusted positions very substantially. European banks are very crowded. U.S. tech is less so, and we're beginning to see people coming back.
Marija, I just want to wrap this up with gold. We had gold go above $3,000 on Friday. If some of the panic is going to be taken out of markets, if earnings are going to look stronger, if some other parts normalize, does the trend in gold then to normalize? Have we seen the extent of gains for the precious metal?
Yeah, no, I think you're exactly right, Danny. So gold potentially is like a kind of a fear gauge for maybe more retail investors, and it is very elevated. And so if we're beginning to see normalization, I think people can come back to like U.S. equity tech. Those trades would be kind of the other side of the trade, definitely.
Marija, thank you so much for joining us this morning. There is no one else we'd rather start our week with. Marija Veitmane of State Street. Great to see you this morning. Let's get you some other top stories that are trending on the terminal today. UBS, speaking of European banks, have trimmed CEO Sergio Monti's pay to $17 million for 2024, the tiniest violin for Monti. That is below the maximum amount that he could receive. Swiss officials have been scrutinizing banker pay. Monti's 2023 compensation had caused an uproar in the country. The finance minister said that it exceeded, quote, the imagination of any normal citizen. AstraZeneca has agreed to buy the Belgian biotech company Esso Biotech for as much as $1 billion. That deal aiming to boost AstraZeneca's cancer capabilities. That transaction also expected to close in the second quarter. Now, it's the end of an era. Forever 21, a brand that drew young women and girls to shop for cheap, trendy clothes, has filed for bankruptcy after years of poor performance. The retailer said it would wind down its U.S. operations while also pursuing a going concern transaction or a sale of some of or all of its assets. This is Forever 21's second bankruptcy. We'll see if this one sticks. Coming up, President Trump says that he'll be speaking with Russian President Vladimir Putin tomorrow. We'll set up your agenda next on your brief.
Speaking to President Putin on Tuesday, and a lot of work's been done over the weekend. We want to see if we can bring that war to an end. Maybe we can, maybe we can't, but I think we have a very good chance.
President Trump there aboard Air Force One telling reporters about efforts to end fighting in Ukraine. On the agenda with a phone call, a conversation with Putin is a potential 30-day ceasefire. For more, let's bring in Bloomberg's Greg Sullivan. Greg, the 30-day ceasefire is one that Putin had pushed back on, that they wanted something different. Is there any reason to believe that there will be more accepting of this deal come a conversation with Trump and Putin tomorrow?
Well, it's certainly significant that Trump says he will be speaking to Putin and does hint at the fact that maybe they could come to some sort of agreement. But it's difficult to see what exactly that would be, given that Russia, as you say, has pushed back on the idea of a short-term ceasefire. Additionally, Russia has made lots of demands to come to the ceasefire, such as not arming Ukraine and demands for a more longer-term settlement that are unlikely to be palatable to Ukraine. This, of course, leaves European allies concerned that as Trump speaks to Putin, they could agree on some sort of truce or ceasefire that leaves Ukrainian security guarantees inadequate.
I mean, again, we have Putin saying that Ukrainian troops need to lay down your arms, kind of what we're talking about, Greg. Is there a disconnect about the conversations taking place between the U.S. and Ukraine and the conversations happening with the U.S. and Russia?
There's definitely what we've seen is a one-sided pressure campaign. Most of the pressure that we've seen has been heaped upon Zelensky and Ukraine, whereas Russia has largely escaped somewhat unscathed. We have heard from U.S. officials and Trump himself that they are willing to put new penalties on Russia, but so far there's little evidence that they're preparing to do that. So most of the time, what we've seen is very different conversations happening between Ukraine, high pressure, and between Russia, which has seemed more conciliatory.
Now, elsewhere, Greg, the U.S. has said that it's going to vow unrelenting strikes on Houthis over the ship attacks in the Red Sea. Pete Hegseth was speaking on Fox yesterday morning. Let's just take a listen to what he had to say.
This campaign is about freedom of navigation and restoring deterrence. The minute the Houthis say, we'll stop shooting at your ships, we'll stop shooting at your drones, this campaign will end. But until then, it will be unrelenting.
I think many people need to be reminded that we have been striking at the Houthis. The U.S. has been striking at the Houthis for more than over a year. So, Greg, is this a shift? Is this a significant escalation?
Well, there's a few things here. One is that it does seem that this is a new size and scope. The latest attacks were bigger than what we saw under the Biden administration, but the U.S. so far, U.S. officials are signaling that they're not ready to put boots on the ground, that boots on the ground are not being discussed. That means that it will be very difficult to dislodge the Houthis. So one other thing that we heard was that U.S. officials said this could be read as a warning to Iran. Iran, of course, backs the Houthis, and this could be a U.S. signal toward Iran to stop supplying the Houthis. And in fact, one U.S. official said that Iranian targets in and near Yemen, such as ships, could be on the table.
How do we understand how this is going to be impacting shipping routes, Greg?
Well, the Houthis' attacks have already had an outsized influence on shipping, causing many ships to reconsider taking the Red Sea route between Europe and Asia. But these renewed attacks by the U.S. could have a broader implications for the region as well. There are concerns that the Houthis could lash out against some of their Gulf neighbors in retaliation, and that, of course, will have significant implications for the region.
Greg, thank you so much for that update. That is Bloomberg's Greg Sullivan. Coming up on your Bloomberg Brief, China's economic resilience. The country kicks off the year with some strong data and plans to boost consumer spending. We'll have that for you next on Bloomberg. This is Bloomberg Brief. I'm Danny Berger in New York. Let's take a look at the front pages this morning. What's making headlines? First up, the New York Times leading with the Trump administration denying that it had violated a court order by deporting hundreds of Venezuelan immigrants to a prison in El Salvador. White House Press Secretary Caroline Leavitt says that the president has broad powers to quickly expel them under an 18th century law meant for wartime. All of that happening despite a court order blocking the administration from doing so. Next up, we have this from the Wall Street Journal, leading with job seekers struggling with salary deflation. Now, the salary difference between those who stay in their roles and those who change jobs has narrowed to the lowest in 10 years. Those who stayed in their jobs increased their wages by about 4.6% in January and February. Those who switched jobs, it was only slightly more at 4.8%. Next up on the Bloomberg, Chinese consumption, investment, and industrial production, all of those exceeded estimates to start the year, pointing to a sign of resilience for the economy, still in need of more stimulus with President Trump's tariff threats going. And perhaps that stimulus is on its way. For more, we are joined by Asia economics reporter Katya Dmitrieva in Hong Kong. Katya, we got the economic data, but from China, we also had plans to boost consumption. How far do those plans go?
Well, that's a great question. It seems like every time we chat, it's always about plans and Chinese economic officials and how they're developing those plans. But we don't really have any solid details or numbers from the press conference today. So we heard that officials do want and are thinking about things like child subsidies. They're thinking about raising employment income in a gradual fashion. But we don't know exactly how they're going to plan to do that. In fact, when a colleague of mine asked officials these questions, the answer was that they are currently studying them. And so that's why you saw stocks not really reacting very much to this press conference, because that's the big question for China's economy, of course, is how they're going to make this about 5% GDP growth target this year, especially when they're so focused on consumption and letting consumption lead as opposed to trade, which, of course, we know with tariffs will be a lot more difficult.
There was also a bullet point in their announcement talking about the Chinese equity market. Katya, is there a desire to shift the avenues of wealth in China to something that looks a little bit more American, something that goes away from just the property market, but to things like stocks and bonds in the region?
Yeah, that's certainly their hope. I mean, the hope is that you move away from just this sort of industrial production, export-led growth, which is sort of the two-track economy we've been seeing, right? So this growth in output and trade and a lot of concern from foreign economies, of course, and companies about the low-priced goods. And then the other side of the economy, consumption, has been pretty weak. To start the year, of course, things came in pretty good. Sort of more like better than expected, a lot better than expected. But in the private sector, we have seen some moves as well with officials. The tech sector being a big one, of course, with DeepSeek and speaking with executives. There's also another meeting coming up in China with President Xi himself due to meet with some global executives, which kind of shows you that they're hoping to lift those animal spirits further and hopefully drive some stock gains as well.
Yeah, that would be really interesting to see just who attends this year. Katya, in the data that we got, how much of the surprise, how much of the growth from China is still coming from exports? Exports that might worry the likes of Europe, for example, if the U.S. continues to push back and continues to implement tariffs, and that excess and that capacity seems to be going into different markets, again, like Europe.
Yes, absolutely. There's sort of a global China shock that we're seeing taking place, and it's only expected to get worse as these tariffs come in, because if you have an economy that's still, as we saw today from the press conference and from economic data, that's so reliant on the industrial production and on government spending for that, rather than sort of more of a Western-style model where consumption reigns, then you're in the same situation as you were in last year. And in fact, you're going to have these companies in China who are looking for more markets and selling at a lower price. We've had deflation now in China for several years. There's warnings that that could actually get even worse. And so if you're, for example, in the Eurozone, if you're a company in Canada or the States, you're certainly going to be worried about that, which is another kind of external pressure on China to rebalance things in the economy.
Katya, thank you so much. That is Bloomberg's Katya Dmitrieva in Hong Kong. Coming up, we're going to preview the week ahead. It's a busy one. We'll be speaking with Kathy Jones, Chief Fixed Income Strategist at Charles Schwab. That's coming up on your Bloomberg Brief. From our global headquarters in New York City, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Not worried. After 4 straight weeks of declines, Treasury Secretary Scott Bessent says corrections are healthy and normal. Pushing for an end to the war, President Trump says that he'll speak with President Putin tomorrow, saying progress is being made. Pumping up consumption, China maps out its plans to boost spending. It is a busy week this week. It kicks off with retail sales data today. Also for central banks, it is busy. The S&P 500 managed a 2% plus rally yesterday. Not yesterday, Friday, but you know, what are days? What does it mean? Monday is the date today. S&P 500 futures and NASDAQ are lower by about 0.4%. If we get another loss this week, it will be the longest losing streak for this equity market since 2022. By the way, we're getting downgrades abound. RBC's Lori Calvasina, the latest to downgrade her year-end forecast. Most of the sell side citing lower economic outlooks, a lower GDP growth. Now, for your bond market, there was more stability today. There was a jump in yields on Friday after the UMich data. That inflation expectations reached the highest since November of 2022. 4.28 is where you stand on your 10-year yield. Some strength coming in from this oil market. We are up 1%, with the U.S. saying it will have unrelenting strikes on the Houthis after their attacks. Meanwhile, you also have China boosting their economic consumption plans, all of that supporting oil. Now, as I mentioned, it is a big week. Let's just try to go through the calendar. We have 3 major central banks out with decisions. We're going to have the Fed and the BOJ on Wednesday, then the BOE on Thursday. We're also going to get a read on the U.S. consumer today. We're going to get retail sales. By the way, we also have German lawmakers voting on hundreds of billions of euros of spending. That vote starts to kick off tomorrow. There is so much for this bond market to keep track of, and that's even before any policy pronouncements we might get from the White House. Joining us to help set us up for it is Kathy Jones, Chief Fixed Income Strategist at Charles Schwab. Kathy, that is a busy calendar. Just how are you thinking about the setup for this week?
Yeah, well, the first number is going to be the retail sales. I think we're going to be looking at that to see what the strength of the consumer looks like. There was weak in January, but there probably were some weather-related factors there. So looking to see if there is a rebound. And our biggest concern going forward on the economy is, will consumer spending slow down because of the various factors that are at work right here. And so once we get to retail sales or get through that number, then we really will focus on the Fed and see what the comments are from Fed Chair Powell about the economy and the outlook for policy going forward.
So to pick apart a few things, the University of Michigan figure on Friday, I think spooked some people, Kathy, because yes, there are political biases in that survey, but it showed inflation expectations going up really across income, age, education, political cohorts too. There was a jump in independence. How much do you worry about some of these sentiment readings? Because the sentiment readings have been poor, whereas the hard data has been decent, let's say.
Yeah, I do worry about the sentiment readings, especially inflation expectations. Now, this is a survey, as you mentioned, that really underlying it, the political affiliations have a big influence on. But it is significant that half or more people expect inflation to continue to rise at a pretty hefty pace. I think the effect of tariffs is working its way through the system. And even if we haven't had all the price increases associated with tariffs, the expectation is that we'll get them. So it does concern me because it can constrain what the Fed can do, even if the real economy slows down. If inflation expectations are elevated, it makes it very tough for the Fed to move on policy.
So then you have a front end that's been really pinned down by what the Fed can do. Kathy, what about duration at this point? Do you expect long-term yields to be moving up higher, just given the kind of outlay that you're describing?
Well, in the long run, we actually think they're going to come down a bit. And the reason is that we do see the economy slowing probably visibly in the third and fourth quarters as we see the impact of tariffs affecting spending and all of the uncertainty affecting the ability of businesses to really plan and move forward with expansion. And then we're seeing some deterioration under the surface in the labor market. So you combine all those factors, and I think second half of the year there's a good case for bond yields to come down. But in the short run, we're pretty concerned. We don't want to extend duration here because we think that there's going to be just a continued volatility and some inflation pressure coming from the tariffs. So it's kind of a sequencing issue, higher in the short run, lower in the long run.
Well, with all of that, we finally have seen some moves in high yield spreads, Kathy, and it's taken a long time for us to get there. They had their biggest move wider last week since the turmoil of last summer. But again, even with that move, it's not necessarily extraordinary. It doesn't look as bad as things look in other risk assets like the equity market, for example. Does that widening continue? Are you seeing signs of cracks in junk bonds?
Yeah, we think in high yield, there's room for them to widen further. As you mentioned, they're still low. They had a big jump, but they're still pretty low. And I think with the equity market floundering here and potentially softening because of all the cross currents in the economy and in policy, there is room for junk bond spreads to widen from here. So we're pretty cautious on high yield. We're much more constructive on investment grade, even though those spreads could widen a bit, not likely to have the impact, the negative impact on total return that you might see in the high yield market.
But isn't there an element, Kathy, where this is a bond market that looks completely different, that it's just higher quality in general because so much of it has been moving to private managers? Is there a degree which the corporate credit bond market just doesn't act as robust of a signal as it once did?
Yeah, I think that's a possibility because, as you mentioned, private credit has taken a lot of the lowest quality off the radar for us and out of the market for us. But you know, the economy is what the economy is. Those spreads are still going to respond. If we have a slowing economy and concerns about rising defaults, we're going to see those spreads widen. So maybe it's higher quality overall than it used to be, but still the dynamic is there that could widen spreads from here.
Kathy, before we let you go, I just want to end on this because tomorrow we're going to get a vote on Germany, tomorrow and Friday, on some of the spending measures that they want to be putting through. The spread between treasuries and bonds has really collapsed. It's around 140 basis points. At its peak, it looked something like 230 basis points just 3 months ago. Has that gone far enough, Kathy? Have markets fully priced in the rewiring of debt that we are about to see with Germany and wider Europe turning to issuing more, to allowing that more spending and putting aside decades of austerity?
Yeah, I don't think it's quite run its course. I think it might have the majority of the spread differential is probably in the market now, but I think longer term, there could be more. You know, 3.5% of GDP on defense spending is a big move for the major economies in Europe. So I think that we could see some more spread widening. And, you know, obviously it's been a very, very long time, right? It's a huge shift in the overall economic outlook for Europe right now relative to, say, the U.S., where we're expected to soften a bit and they're expected to boost spending quite substantially, which could boost growth fairly substantially.
Yeah, a long time coming. Kathy, thank you so much for getting up early, for joining us on this Monday morning. Good luck for your week. I think we all need it. Kathy Jones of Charles Schwab. Coming up, reciprocal tariffs are coming. Not this week, though. At least you get a little bit of a break on that front. Well, we'll see. President Trump indicates that more tariffs are in track when that deadline comes in just 2 weeks' time. Good morning. You're watching Bloomberg Brief. This is Bloomberg Brief. I'm Danny Berger in New York. President Trump signals that he plans to push ahead with a more aggressive tariff regime. He told reporters aboard Air Force One that broad reciprocal tariffs and additional sector-specific tariffs will be imposed come April 2nd.
It's going to be reciprocal. In other words, whatever they're charging, we're charging. Very simple. If they're charging us, we're charging them. It's no longer they charge us and we don't charge them.
Joining us now is Bloomberg government reporter Kate Ackley in Washington. So, Kate, no backing down.
For now, right? We see this, it kind of comes and goes. The tariffs are on, the tariffs are off. It's really roiling the U.S. lobbying community, the business community, not quite sure how to respond. A lot of them are waiting for data. When tariffs actually go into effect, how does it affect prices and inflation? Things like that. We're going to be watching, this week, Congress is out of session. So members of Congress will be back home in their districts. Now, we know that a lot of Republicans have decided not to have town hall meetings, but they'll still be home for the most part. They'll be available to constituents. What are constituents saying about the tariffs that are supposed to take effect April 2nd? Is there a widespread backlash at all? Are business leaders in Republican congressional districts and Republican states, are they mobilizing at all this week, to fight back against the tariffs or to subtly, sort of whisper their concerns to Republican lawmakers about the tariffs? That's what we're going to be following this week.
Well, over the weekend and on Sunday, Kate, there were some really, really brutal polls put out for the Democrats. There was one from NBC saying that just 27% of Americans like the job that the Democrats are doing. CNN put their net favorability at 29%. That's apparently the lowest rating in the 33-year history of the survey. Kate, is Trump really likely to listen to either what some of the constituents are saying to their congressional members or what some business leaders are saying? If he's not feeling that pressure from the favorability numbers from the Democrats, regardless of what his polls are doing, will he not feel more emboldened to go forward?
Well, we saw last week, as we were talking about the debate over the government funding situation, we saw divisions within the Democratic Party just, completely open air. Republicans, House and Senate, all kinds of, sniping at one another. You talk about the polling for Democrats. Some of that is Democrats, I would assume, thinking that their party is not standing up strong enough. We saw a lot of backlash to Senate Democrats' decision to vote for the continuing resolution, the government funding resolution at the end of last week. So you have a lot of division within the Democratic Party. But what I'm talking about is more looking at what are Republican members of Congress hearing. I think what they're hearing and what they say to the administration will obviously have a little bit more sway than what Democratic members are saying. But we are monitoring both and certainly checking on the Democrats' resistance and the divisions within the Democratic Party, which have been on full display recently.
Kate, also on the agenda for the White House this week, tomorrow Trump says that he's going to be speaking with President Putin. What are we expecting out of a potential phone call between the two of them?
Well, what Trump said, and I think this was also aboard Air Force One as well, that he was planning to talk to Putin on Tuesday, as you said, and he mentioned that there was going to be a lot of discussion about land. President Trump has said he wants to end the war in Ukraine. He's been saying things very favorable to Russia, and he's talking about land, sort of dividing up this land in question. So we'll be monitoring that. That's also on the agenda this week.
Well, a busy week, even with congressional members at home. Kate, thank you so much for helping us set it up. Kate Ackley of Bloomberg Government. From the U.S. to China, the country's central bank is looking into plans to boost consumption. That involves increasing low-cost financial support for key consumption areas. Joining us now is Bloomberg's Alan Wan. Alan, great to see you. Just how far do these plans go?
Well, they didn't go far enough. I mean, the market was pretty steady throughout the day. But it's very important. I mean, a lot of economists were saying that it's a good start. It's a skeletal plan, but it's a good start. And the focus is going to be on stabilizing household incomes. Basically, how are you going to promote consumption when people feel like they're getting poorer? So they're getting measures to stabilize household incomes. There's also going to be efforts to promote consumption of new services. And there'll be government efforts to alleviate the burdens for elderly care, medical care, and health care for folks.
Well, this is a push that the U.S. has also been explicit that they wanted from China, a shift to consumption away from exports. Alan, we also got some China data that surprised to the upside. How much of it is still being driven by exports coming from China?
Yeah, I mean, the first 2 months of the year, it was all exports, really. It's just the front loading of shipments by exporters and a trading program. Exports are still huge, but I think that the government is trying to pivot towards domestic consumption. But right now, the first 2 months of the year is mostly exports. Everything rose by more than forecasts. But you have to be concerned a little bit, just because it seems a lot of these things are just one-off measures. Whether it's the training program, whether it's a front loading. I mean, the government has to do more, especially in doing more on the domestic consumption side. And today there was a meeting, a joint ministry meeting. And there weren't a lot of details, and I'm afraid that markets will be a little bit underwhelmed coming into the open tomorrow morning.
Well, we're also going to get a meeting with global CEOs coming to China. We don't have the exact details of who's going to be there yet. Qualcomm, Saudi Aramco's Ahmed Nasser, reportedly among those who are going to be attending. Alan, how much are we going to see this push that China appears to have been making, at least in tech, to try to support and uplift private sector business as well?
Yeah, I mean, it's going to be a very busy week in China next week. You got the China Development Forum, you got Boao, and then later in the week, on the 28th, sources are saying that Xi Jinping is going to meet some global CEOs. So for the CDF, like you just said, there'll be global CEOs from Saudi Aramco, Qualcomm. But one of the more intriguing visitors is Steve Daines, a Republican senator, a politician, who'll be coming here, and he'll be meeting senior leaders to talk about fentanyl, which is one of the reasons that the Trump administration gave to impose tariffs. So that'll be interesting. And then you get a Boao Forum, and we're expecting another senior leader to attend that as well. And then on the 28th, you've got global CEOs. If they stay, maybe they'll stay for the whole week and meet Xi up in Beijing or Boao for all we know. But it's all part of China's push to show that it's open for business at a time when the Trump administration, with its protectionist American first agenda, is going the other way. And it's also an effort by the Chinese government to show that it's supporting private enterprise.
Alan, we are going to look forward to catching up with you after that meeting on the 28th and what the outcome might be. Bloomberg's Alan Wan. Let's turn to the AI race. Bloomberg sources telling us that Apple's top executives overseeing its virtual assistant Siri told staff that delays to key features have been, quote, ugly. For more, let's bring in Bloomberg's Tom McKenzie. Tom, we also have this 100 executive retreat coming from Apple, but it seems like in the background that AI, this crisis, if we'll call it that, seems to have reached a boiling point for them.
Yeah, look, this was an all-hands meeting, and again, this is a Bloomberg scoop reported by Mark Gurman. So an all-hands meeting led by Robbie Walker, who oversees the Siri team, and anyone who's used Siri recently will know that it's pretty clunky. It hasn't changed much, so there is a big focus on ensuring that Siri can be that voice assistant that its customers, that Apple's customers would expect in this world of generative AI. But there is a long way from that, and to your point, there is real tension. It is a boiling point moment right now, almost kind of like breaking moment. The executive Robbie Walker talking about burnout amongst the teams, talking about the situation being very bad. The context is that the Worldwide Developer Conference, that is the biggest event for Apple, took place in June of last year. They unveiled a prototype that was followed by a marketing and advertising campaign. And the truth is, they don't have anything close to a working prototype. They didn't in June. They were hoping to launch it in spring of this year. Now it's been pushed back to next year at the earliest, this updated Siri assistant. And the team has faced all these challenges in terms of engineering challenges and bugs. The idea is that when this voice assistant, when Siri is upgraded, what it'll be able to do is tap your own data on your phone, but also manipulate apps and translate that on screen for you. So it'll be pretty powerful when it comes to pass, when they finally have it out, when they're finally shipping it. The question is, when are they going to do that? And it's been pushed back from spring of this year into next year, again, at the earliest.
They need something to fuel the upgrade cycle, especially in places like China where the data has been bad. Tom, Mark Gorman of Bloomberg has also been doing some reporting on the iPhone 17 to come. I realize more of that's about the hardware itself and not the software, not the AI behind it. But is there anything to suggest that that phone might help us re-enter the upgrade cycle?
Yeah, well, it's the upgrade cycle around hardware that Apple is looking at making progress, of course, and there's a lot of scrutiny in the Chinese market. You were just talking about China there, and in terms of how Apple is partnering with the likes of Baidu and Alibaba to make sure it's not left too far behind. It is playing catch-up when it comes to artificial intelligence. So it does need both the software and the hardware to come together, and the iPhone 17 will be an attempt by Apple to, again, close the gap, frankly, on some of its competitors, many of them in the Chinese markets who are innovating at pace. Talking about management changes, no heads have rolled yet in terms of the Siri team and the artificial intelligence team, but there have been some management changes. And when I've spoken to people at Apple and I've had conversations with them about this, there has been some pretty dispiriting commentary about the AI team at Apple. So that's one to watch as well. Management changes have been put in place. The pressure is certainly on the hardware front and the software front. Now, Apple, the stock is down about 14% year to date, Danny.
Yeah, we'll see what changes come. Apparently that new iPhone is going to be very thin, which scares me because I would probably snap something like that. Tom, thank you very much. Bloomberg's Tom McKenzie. Yes, I'm a klutz, and yes, I drop my phone a lot. Okay, coming up, a slew of central bank decisions are on deck. We're going to hear from the BOJ, BOE, Fed. We'll set up your week to come on your brief. It's your Bloomberg Brief. I'm Danny Berger in New York. Let's set you up for your trading week. First, the data. We're going to get U.S. retail sales data for February. That comes out at 8:30 a.m. Eastern. Then the Fed, BOJ, they both announced rate decisions on Wednesday. Then on Thursday, it is the turn of the BOE. A quick check on your oil markets this morning as we head to the end of the hour. We are looking at advances. We're off the highs. We're up by more than 1% at one point. We're up just 0.9 for NYMEX crude and Brent. Two factors to keep in mind. It is China making plans to boost their consumption. And then at the same time, we have the U.S. announcing that they would do more strikes on the Houthis as they attack in the Red Sea. Even among all of that, we've had Goldman Sachs downgrade their oil forecast, pointing to both OPEC Plus pumping out more and concerns of an economic slowdown. Now that is it for your Bloomberg Brief. Surveillance will take things from here. This is Bloomberg.